Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Sipe and Associates. As always, I want to say thank you for taking the time to listen. And above all, thank you for your service. You don't hear it enough. You will always hear it here. We are back today with my friend and brother, the incomparable, the guru, Ed Zurndorfer, as part of our ongoing mission to reach, teach, and serve you. And I want to point out that we have expanded that capability. And we now have, you can go to the website, www.stwserve.com, and you will see our full suite of Ed Zurndorfer webinars. And they are awesome. And we're having a lot of fun with them, aren't we, Ed?
Oh, I love it. It's great.
Yep. So all the great stuff that you would get in Ed Live is now coming to you in the safety and comfort of your home, office, wherever you happen to be sheltering for your safety, because Ed and I are indeed remote. We are still working our way through the pandemic, as is everybody. So we want to keep everybody safe. But as we are fond of saying, you can learn from Ed Zurndorfer wearing your bunny slippers now. And that is a really, really, really good blessing. So at the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. So, Ed, we are talking taxes, okay? And for those of you who don't know, in addition to being one of the foremost people in the area of federal benefits, Ed is also an enrolled agent with the IRS. Okay, so he is definitely the right guy to be listening to where this type of thing is concerned, and he can go super deep on this stuff. He has taught us so much, so this is really great. So by the time this posts, the COVID tax date will have passed. Okay, but there are some enduring pieces of advice that can always be culled from Ed's FedZone articles, because here's something I learned, and Ed, you can confirm that this is in fact true. The one thing that I have learned is that when I pay my taxes this year, they are going to ask me to do it again next year.
I can confirm that, Dan.
There we go.
No statute of limitations.
So a lot of the things that, and he got his article out in late June, and that's one of the things we'll be talking about here. So with the July 15th date, some of the information that we will recap here is going to be relevant going forward. One of the things, Ed, that you always bring up, and you are one of the few guys that I've seen on the speaking circuit going to feds that is meticulous about doing this, is you bring up the importance of filing the IRS Form 8606 when making a non-deductible IRA contribution. And I think we have a lot of people that might be listening and say, "Oh yeah, I don't deduct it anymore, but I've been putting money in. What's this 8606?" And that's one where we hear that as planners who go, "Oopsie, there's going to be some work to do here." So a lot of folks do have active after-tax IRAs. So why don't you walk us through the importance of that 8606?
Absolutely. Dan, I just want to bring one thing up. Yes, you did mention we're past the filing deadline by the time you hear this podcast. However, if for some reason you did not file your 2019 taxes, it's never too late to file your taxes. As a matter of fact, you should do something. Even if it's after the July 15 filing deadline, file an extension, pay whatever you can, whatever if you can afford, do something. The worst thing you can do is ignore the deadline, because the penalties for not filing are horrible. And so please do something. So again, if you didn't get your taxes done and you want to get an extension, if you actually are expecting a refund on your 2019 taxes, you really do not have to formally file for an extension. You can file anytime up to October 15th, but if you do in fact owe, you did an estimate of what you think you're going to owe for 2019, you have to pay whatever you think you owe, and then you'll get an extension to file until October 15th. So, again, please do not ignore the deadline, and also do not forget about your local state. Whether you live locally, Maryland, D.C., Virginia, the tax filing deadline was also July 15th, so don't ignore your state. Okay, so let's talk about IRS Form 8606. There are two types of IRAs, Dan. One is called a traditional IRA. That was the original IRA, started in 1974. And then we have what's called the Roth IRA that started about 24 years later in 1998. A traditional IRA can be broken down to two types. One, a deductible traditional IRA in which the contribution you make is a deduction on your income taxes. In particular, it is an adjustment to your income. If your total income, let's say, is $100,000 and you contribute, let's say, $6,000 to a deductible traditional IRA, then your adjusted gross income will be reduced by $6,000, bringing you down to $94,000, and then you're going to be taxed on $94,000. In other words, you're saving taxes now in 2019 by making a deductible traditional IRA for 2019, or for that matter, it's too late for 2019, let's say for 2020, because you can make the same contribution for 2020 as you could for 2019. And the deadline for making a 2020 IRA contribution will be next April 15, 2021. All right, so a deductible traditional IRA contribution results in a tax savings now, and any earnings you get within the IRA, that is interest, dividends, however you invested, those earnings that you're getting are not taxed. The only time you're going to pay tax on that deductible traditional IRA is when you withdraw it. You're getting what's called tax-deferred earnings, and your contribution is also not taxed until it's withdrawn, which could be many years down the road. Perhaps you'll be in a lower tax bracket, so you're looking forward to taking the money out and paying tax at a lower rate compared to had you had to pay tax on the contribution, which brings me to the next type, and that's called a non-deductible traditional IRA. A non-deductible traditional IRA, the contribution you make does not result in a deduction on your taxes. In other words, the contribution you're making is already tax dollars. There's nowhere on the tax return that says you made a deductible, let's say the Form 1040. The 1040, you report your contribution to a deductible IRA right on the Form 1040. It's an adjustment to income. But with a non-deductible traditional IRA contribution, there's nowhere on Form 1040 that you report your contribution. So the money you put in is already tax dollars. The earnings that you're getting in that non-deductible traditional IRA, whether it's interest, dividends, capital gains, whatever, however you invested, all those earnings will grow tax deferred. And when you withdraw that money from the non-deductible traditional IRA, you will only pay tax on the accrued earnings. Why? Because you already paid tax on the contributions. So here's the question, because as you mentioned, I'm an accountant, I have a tax practice, and invariably I have people over the age of 70 and a half who come to me, and they had to take money out of their IRA, and they give me their 1099-R, that's a report of their distribution, and box 1 of the 1099-R says gross distribution, say they took out $10,000, and box 2, which says the taxable distribution, it says the word unknown. Unknown. Now, as an accountant, when you see the word unknown, it gives you a horrible feeling in your stomach. I sort of have to go to the Pepto-Bismol when I see that, because I'm forced to ask the question to the client. This IRA you opened up, you contributed to. Was it deductible or non-deductible? And usually the reaction I get from the client is, huh? What are you talking about? I said, did you deduct the contribution? Oh, I don't know. I don't remember. Well, do you have your tax return? I think so. I'll get it. And when the years that you contributed, and it doesn't show up. So then I have to say to the client, I have no idea what this contribution you made was deductible or non-deductible. Did you file the Form 8606? Because on Form 8606, you officially tell the IRS that the contribution you made to the IRA was already taxed, as it was made with after-tax dollars. This is your proof that you already paid tax on the contributions. If you don't file that Form 8606, the IRS will say, we're sorry, the money coming out of the IRA is entirely taxable.
Ouch.
That's the contributions and earnings. The proof that you made a non-deductible traditional IRA contribution is only with Form 8606. It's been my experience over the past 34 years in which the Form 86 has been around that this is one of the most unused IRS forms because people are not aware of the fact that you got to file that Form 8606 when you make a non-deductible IRA contribution. Now that's the bad news, Dan. Now comes the good news. If you go back to the years that you made all these non-deductible IRA contributions, you're certain you didn't deduct a contribution. The IRS will allow you to file Form 8606 by itself. You do not have to amend your tax return. Just file the form for the year that you forgot to file the Form 8606, reporting your contribution, and IRS will say, thank you very much for filing the form. There will be a $50 penalty, I believe, for filing the form late. But to me, the $50 penalty is a lot better than for the IRS to say, we're sorry, but all that money you put into the IRA, we assume was with pre-tax dollars. So if anybody out there contributed to an IRA for the year 2019, they already filed their taxes, they made their 2019 IRA contribution, and they're absolutely certain it was a non-deductible traditional IRA contribution. How do you know it was non-deductible? Because they didn't deduct the contribution on their taxes. They didn't deduct it. And why wouldn't they deduct? Why would a federal employee not deduct their contribution? Because most federal employees, because they're covered by a pension plan, CSRS, FERS, the TSP, and their income is too high that will allow them to deduct the IRA contribution. They, in fact, if they're going to make a non-deductible, if they're going to make a traditional IRA contribution, it most certainly will be a non-deductible IRA non-deductible. The contribution will be non-deductible, and they have to file the Form 8606. So, if in fact you for 2019 you made that contribution to a non-deductible IRA, it is not too late to file Form 8606 by itself.
Gotcha.
You're going to download it from IRS website, send it in. You won't be penalized because it's still for the year 2019. There would be no penalty. So that's why 8606 is a very, very important form. I also want to mention that the Roth IRA has no form requirement. You don't have to file any forms when it comes to contributing to a Roth IRA. The only problem with a Roth IRA is it has income limitations. There are people who, individuals whose income is too high, in which, because of that, they're not allowed to contribute to a Roth IRA. So,
gotcha.
So individuals have to be aware of that.
And folks, if you're listening to this, don't panic. That was a lot of information. You can always go to fed-zone.com or blog.stwserve.com, and that's where Ed's latest columns will always be, and you can go right there for them. Okay, so Ed, your tax article also touched on some filing tips, most notably change to deduction rules for medical expenses. Tell our folks about that.
Yes, for 2019 and probably and through I believe through 2025 under the current tax law, if one itemizes on their federal income taxes, they file Schedule A. Part of the Schedule A itemized deductions is medical and out-of-pocket medical and dental expenses. We're talking about things like co-payments, deductibles, mileage. You get a certain mile. I think it's 23 cents a mile if you have to travel to the doctor. Parking expenses. Well, if you add up all the medical and dental expenses you pay out of pocket, they have to exceed a certain amount of one's adjusted gross income in order for them to be deductible. Until the current tax law, which took effect in 2018, it was 10%. You had to exceed 10% of one's adjusted gross income. It was lowered to 7.5% of one's adjusted gross income. Okay. So I'll be honest with you, Dan. I hope and pray to dear God that no one is able to deduct their medical and dental expenses.
We hope they don't need it.
That could be a lot of money, Dan. You know, you're talking about somebody whose adjusted gross income, let's say, is $100,000. They'd have to pay out of pocket over $7,500. That means one of two things: you or a family member are not very well, or number two is maybe your insurance is not very good. Please, let's try to stay healthy, folks.
There you go. Okay. There you go. And also there was a change to the treatment of mortgage insurance premiums that you touched on.
So-called PMI, private mortgage insurance. If somebody buys a house and they got to take out a mortgage and they put down less than 20% down payment, they're required to pay what's called take out PMI, private mortgage insurance, and those premiums that you pay, the amounts that you pay for private mortgage insurance, the private mortgage insurance premiums, I should say, the mortgage insurance premiums is deductible. Again, that's for people who have less than 20% equity in their house.
Gotcha. And this one was kind of interesting, and it's a bit of a mouthful, but I could certainly see circumstances where it could happen. You said there was also a change in the discharge of qualified residential debt. Now, that's a mouthful, so tell us what changed.
This one hurts in the following sense. If somebody cannot afford to pay their mortgage, okay, and they have to walk away from their house because they just can't afford the mortgage. The bank, let's say the bank sells it, anything that's left on the mortgage, the bank will get whatever they can get. Let's say the house is worth $300,000, but there's a $500,000 mortgage left on the house, so the bank is going to end up getting $200,000 less than what's left on the mortgage. The $200,000 is indebtedness that normally, if your lender forgives your debt, that is considered to be income to you. However, a law was passed a couple of years ago when it comes to one's qualified principal residence that if you have to walk away from your house because you cannot afford the mortgage, that any mortgage indebtedness that's discharged will not be included in income. And this was extended. Congress extended this law from previous years. So it does apply in 2019. It'll probably apply in 2020. I would venture to say it will apply in 2020 because of what's happening with the COVID-19 situation where people lost their jobs.
Sure. And I mean, my heart says, if somebody's got to give up their house, it's kind of insult to injury, to whack them on the forgiven debt as well. So I'm glad to see that. And last but not least, this is really interesting because you're one of the few guys that will dig this deep and come up with this particular point of view. You had some thoughts about when it might actually be advantageous for a married couple to file separately versus jointly. We don't hear about that a lot, so why don't you touch on that?
Yeah, well, I had a few situations in my own practice this year, so I thought I'd bring that up. Normally, when a married couple files jointly, they'll actually save on overall taxes. But there are some situations where married filing separately does make sense. I'll give you one example is that if we have two working spouses both working, and one spouse may be eligible for certain deductions that would not that the spouse would not be able to get, because if you combine your income, a lot of deductions and credits are depend on your income. If your income is too high, the IRS says we're going to reduce, if not take away, that deduction or credit. But if they file as married filing separately, then the threshold for losing that deduction or credit is lowered, so therefore the spouse who's eligible for that deduction credit might be able to get it because they file separately.
Gotcha.
A good accountant, Dan, will always run both scenarios in terms of what is best for the couple in terms of married filing separately versus married filing jointly. One other example that has nothing to do with income, but it deals with this. I have a client in which a young couple, and one of the spouses has a huge amount of student loan debt, huge amount, and so the wife does not want to. The gentleman files married filing separately because the wife says, "I want no part of your any association with your debt." So therefore, let's go separately, because in case he faults, they're going to go after their joint income if they go married filing jointly. That's what they told me. So they said, we don't care what the numbers are. Even if we save on married filing jointly, we're not going to do it. We're going married filing separately. So I said, fine.
Okay.
Case closed.
Household harmony is important. Folks, tax day may have passed, but Ed's articles always has great nuggets to be better prepared for 2020 filing. So be sure to check it out. Again, blog.stwserve.com or fed-zone.com. Okay, Brother Ed, wow. You know, those were just a couple of the comments that you had from that tax filing column that you gave us right at the end of June. And as always, it's just a tremendous amount of information. So, folks, I think that's a good place for us to break, because this tax stuff is really, really chewy. And I know we probably have people going, wait a minute, I need to write that down. Wait a minute, what's that website that I'm going to get the column? So I think that this might be a good place for us to break. And then we will come back in with some of the things that you've written for how things will be changing because of the CARES Act, because of the Secure Act, and that sort of thing. What do you think? I think this is a good place for us to break that?
Absolutely.
Okay. Brother Ed, I can't thank you enough. I am so happy that you really enjoy learning about this stuff, and that you come up with these really interesting ideas and real life examples where people can come up with different ways to file taxes that could be to their benefit. I don't know how you do it, but I'm glad you do it for us. Folks, we are serving those who serve, and we will be back again. We'll be back to finish this up with the rest of our tax talk with the incomparable Ed Zurndorfer. So be sure to subscribe to this podcast on our YouTube channel and also Spotify. Please remember to share it with friends, strangers. Give your enemies a break. Throw them a bone. Let them know. And we have regular listeners now. I can see them. I can see the logging on and the numbers going up. It means the world to me. So the more you pass this along, the more feds will be able to reach. Share the website, stwserve.com, because I touched on this at the beginning. We have Virtual Ed. We have a suite of 8 webinars. They are dynamite. Ed's normal full day is broken up into 8 bites, and you're actually getting more than you would on the full day. It's dynamic. There's live Q&A. It's hosted by Wes Battle and Jen Meyer. They are phenomenal. And Ed is just really lighting it up with it. Don't miss that. Be sure to go to our website, www.stwserve.com. Virtual Ed, the guru, comes to you. Live webinars with Ed as we work to reach you where you are, teach you where you are, and serve you where you are. And that is keeping you safe, but also getting the things you need. So go to stwserve.com, click the blue webinar box, and you will see the full menu. Sign up for one, sign up for all. And be sure to share it with your friends. They will thank you. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, and Wes Battle, I know you're stealing this from me on those webinars, but it's okay. Above all, please remember, it's your FedLife. Make it a great one, because you really deserve it. Stay well, everybody, and we are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.